GM everyone, and welcome to this emergency broadcast of Flywheel. We have a lot going on. Literally 2 days ago, if you had USDC pegging by 10 cents on your bingo card, like that's absurd. That's insane. Like if you had that on your bingo card, like congratulations, you're a psychic. But I'm sure 90% of people didn't. So this is a pretty shocking black swan event. First it started with Silvergate. They wind down deposits, and then SVB happened. And, I'm just getting like reminders and murmurs of 2008. I mean, I was still in high school when that happened. I didn't really get the full gravitas of the situation or how things actually worked. But now it's like interesting being in DeFi for a bit and having this background and seeing like, oh, so they just basically made the wrong choices and wrong bets based on information they received and guidance they received from the Fed. And now everything got bellied up because of poor risk management. Sam, you have been looking at this for the past 12 hours doing research, compiling articles, and getting all your thoughts together. What do you make of the situation? And, obviously what's on everybody's mind watching this is how will it affect Frax going forward?
So I've been a stablecoin bull for like as long as I can remember, essentially since they came out. But yesterday was the first time where I've really been like shaken to the core about like what I saw. Right. Maybe this started with Do Kwon when he said that, by my hand DAI will fall. Right. And then here we are like a year and a half later and DAI's depegged 10% and so is Frax. But yeah, it's this previous 48 hours has just been incredible. I think like before we get into the details of what happened, I just want to make clear that I think that this is all a result of a lack of policy and clear guidance from the US, where they've pigeonholed these stablecoin issuers into really a gray area where they're operating as private companies. They're not a bank. They're not in the banking system, but they have access to banks, and it's put them in this strange place where, like we've seen with Circle just a couple of days ago, they're having to keep their custody of the reserve assets at a bunch of different banks. So they have they have two things. So Circle's made up of cash and then short-term treasuries. The short-term treasuries will be held by a securities broker somewhere, and that's fine. It's mainly then the cash that becomes an issue. Taking a look at Circle's portfolio, they had about $11 billion in cash that are spread out across 6 or 7 banks right now, with the majority of it being at Bank of New York Mellon. And the risk here, which I hadn't really thought about, but we see it now, is that one of these banks fails, and Silicon Valley Bank is, I think, the 19th largest bank inside the United States.
It's huge.
This is not a small bank at all. And so I think Circle probably trusted them quite a bit based on how much they put there. They had about 33% or so, about 30% of their reserves at one bank, which seems like a lot.
And I want to give some context about Silicon Valley Bank. Silicon Valley Bank has been around for over 40 years. It's an absolute institution in Silicon Valley. Anybody banks there. It's highly recommended by VCs, other founders. Like if you're raising around and you just secured it, you go put your funds in Silicon Valley Bank. That's just a thing. If you were at like a major bank or traditional bank like Citi or JP Morgan or whatever, you would kind of get like laughed at, like, oh, you're not an SVB, blah, blah, blah. So like Silicon Valley Bank was like the bank, and like the fact that it went belly up is, it's really unimaginable.
Yeah. So like leading into the pandemic, Silicon Valley Bank was incredibly profitable. It was making about 20% return on equity versus its competitors, right, who were only making about like 11 or 12%. So it had a huge advantage by catering to a specific sector, which would be early stage tech and then life sciences. That constituted something like over 50% of their base was just these like two sectors. And that was great, right? So for the past 40 years, the tech sector has just been growing incredibly fast. So even during the dot-com boom, when things got really out of hand, the tech sector didn't slow at all. I mean, Amazon started then, Google was started then. You had all these companies that just like started in the wake of the 2001 bust, and it just had been growing and growing and growing up until the pandemic, when like all of these, like, I mean, the poster child is like the SoftBank startup, right? Like Uber or WeWork or something, where you have a company which just is burning cash, billions of dollars of cash, and requires ever more financing. And that's great for a bank like Silicon Valley Bank, because they're the ones who are handling the financing. They're helping companies raise new share or issue new shares, and then they're issuing all the loans for it. But pandemic kind of threw a wrench in everything. We were all kept at home. Businesses were shuttered, and that boom that came from this kind of tech's meteoric rise just ended, and venture funding kind of wound down, which means that there was less money for the bank to make. Also, the amount of money that these startups had declined as well too. Mm-hmm. And so this just put a lot of pressure on the bank coming into 2020. And then into 21 and 2022, we had the massive bailouts from the U.S. government. We increased the money supply by like 30% during that time. And these banks, especially at the top, right? So like Silicon Valley Bank and some of its other peers, were just like awash in new deposits. These companies had billions and billions of dollars that they just deposit into the bank. The bank has to find out something to do with it. Mm-hmm. So the bank turned around and does what any bank does. It deposits them into both a mixture of short-term and long-term securities. Unfortunately, the bank and many other banks as well too, Silvergate as well, Silicon Valley, and I'm sure a host of other small and medium-sized banks were essentially buying bonds at the top of a 50-year bull bond market, where from the 1970s, bond yields had only gone down. And so, buying long-term bonds was never a significant threat to your business, because you could just say, oh, hey, like in a couple of years or whatever, we're going to have, a lower rate than we're having now. So let's just buy them. But this is really the first time where bond rates have gone up, and they went up a lot. The speed of the increase matters a ton. And it's come out, I saw yesterday that Silicon Valley Bank, and probably Silvergate as well too, didn't hedge any of this interest rate risk. So while like I was buying a house at 3% with 3% mortgage, and my parents were refining out of their house into like a 2.8% mortgage, like these are the banks that were buying that debt from us at these incredibly low rates, and it screwed them in the long term now.
Yeah, it's pretty insane to think. Oh, going back to what you were saying about like tech and SVB's role in it, like tech as a growth sector is relying on interest rates, not just like tech itself, but I guess the bank that finances them as well. And once those interest rates started to rise, funding growth becomes less attractive, and you kind of just get this, domino effect of deposits leaving, less investment and this and that. And, it really marks an end of an era, the fall of SVB, of, what does this mean for not just crypto, but like growth and startups in the US as a whole? Like, who's going to be the bank to fund them? I feel like, and even from like a political stance, you have the right, or like you have the left, like demonizing billionaires. You have the right demonizing, the tech people, tech woke people, blah, blah, blah. It doesn't seem to like add up into a good situation at all. I'm not sure what the outcome is going to be. I'm not sure, like, I'm curious what the political will is to save. I'm sure that like, you have to think like for the political will, like it's not just like a few tech companies. It's like all of Silicon Valley and a lot of early stage tech, and not even just tech, but like life sciences and everything relies on Silicon Valley Bank. And even like even the founders in them, like the founders bank with them, and get mortgages and houses and financing. Like this is an absolute disaster. This is the second largest bank failing in the U.S. after before Washington Mutual back in 2008. We're in the fact that like over the weekend we just have to wait till Monday. That's awful. Like this should have been figured out Friday. Like and if they don't figure it out Monday, like there is a such thing as contagion. And you saw all those other stocks tank, like First Western Republic and other ones. This is like the FDIC needs to like nip this in the bud. And like I hate to like now I understand like what the banks meant by like bailouts and stuff. And I hate to see a like use that term bailout, but like what should be done in this situation to like contain the fallout?
So 2008 was a little bit different, right? Where the banks were betting on like risky credit events, right? This is a little bit different, where the speed of the rise in interest rates was so fast that financial institutions around the world, right? It's not just Silicon Valley Bank. I mean,
Yeah.
this is a global problem, right?
This is like the tip of the iceberg, honestly.
Yeah, I don't know if you remember last year. I think it was in Q4 last year when the entire UK pension sector was under threat and had to get a bailout. They were like hours away from being fully liquidated because they had bet the farm on these like long-term dated treasuries.
I do remember that.
Or the gilts. And they had some weird synthetic products that they were using as well too. And just the speed of the rate rise, because normally they're like hedging this stuff, but the speed of the rate rise was so fast that it almost wiped out like hundreds of billions inside the for UK pensions. And the Bank of England actually had to step in and provide credit lines. Nobody in our lifetime really has gone through an inflationary period. And so all of us are learning things for the first time about like how inflation works, how the rise in treasuries affects these different companies. And, Silicon Valley Bank and Silvergate are just one of the few first casualties.
That's right.
Yeah. And so my question now is like, is this a knock on to the broader economy, or is this just limited to the tech sector, right? Because like the two banks that have failed so far pretty much have full tech exposure, right? So Silvergate just had crypto exposure, and
but like you said, like if banks made the same bet as Silvergate did, or as Silicon Valley Bank did, and bought like mortgage-backed securities at 10 years and bought like long-term government bonds, because that there's been like there was no evidence to say the contrary, that these wouldn't be safe. And the fact that the Fed went up increased interest rates so fast that the markets couldn't keep up, basically, to adjust in a safe manner. Like, this is beyond tech. This is just like the beginnings of something, it seems like. And unless like this is like contained, if the like proper banks get acquired and whatnot, like it's gonna be a disaster. It's like everyone's like, I don't know, I feel like everyone's been waiting for like, when's it gonna happen? When's like 2008 gonna happen again? Like when's the fall gonna happen? Like how long can the party last? When's the music gonna stop? And like, is this the music gonna stop moment? I guess we won't find out till Monday.
I think it's just starting, honestly, because like now every investor analyst is going to be like hunting for blood, like looking through every single balance sheet to find like whatever information they can about the collateral backing of every single FinCo and bank out there. And I think this could really lead on to some bigger knock-on effects. Like if your balance sheet isn't good and you're over leveraged and you have exposure in this way to treasuries, or just like you're interest rate sensitive, I think you're about to get wrecked. And I think that it's going to be a long, like we're like, what was it again? Like, wasn't there a big gap between like Lehman and Bear Stearns? It was like about a year, wasn't it? Yeah. And so if Luna was the Lehman of our generation, right, we're finally getting towards like Bear Stearns, where the knock-on effects from Luna directly came and precipitated everything that's happening now. So we've been living through this like down cycle for the past like year and a half, and it's now just starting to spread to like the wider economy. And that's what makes me a little bit scared, right? Because either we're going to have this is the first time we've had like destruction of the money base, so like a deflation in the money supply since like 1931. And the last time that happened, we went into a 10-year depression. So I think unless the Fed comes in and starts to bail out these institutions, bails out the banks, it's going to be really nasty. And
you know what? I have a response now.
Yeah.
Honestly, this is why Bitcoin was created.
Yes.
This is literally like this situation was why Bitcoin is created.
I know.
Like literally, like, so for people here, what I was just saying 5-10 minutes ago, like, because like in a dollar world, you need it to be guaranteed by the Federal Reserve and fully U.S. government and all that. So like that's why bailouts and stuff happen. But if that doesn't work out, you have an option to exit into Bitcoin, which has proven to be the most lindy, decentralized store of value over the past almost 15 years. Well,
I think the biggest argument now is that the maximalists can ask the question: Can the failure of any one bank bring down Bitcoin? And I think the resounding answer is no. But now we have definitive proof that the entire DeFi system as a whole is at risk because of one bank failure.
Yeah, like repeat that. The entire DeFi banking system is at risk of failure because of one bank that isn't even it's the 20th biggest bank.
Yeah.
That is bad. I mean, like now you're getting a case though for if like reassessing stablecoins, it should be a requirement for them to get like a Fed master account or like, a stablecoin issuer's license. And I hope like this doesn't create like some campaign by people in the federal government that like, oh, like only certain people like approved by us can issue stablecoins. Like, like it should be like there should be like a stablecoin license, like exactly what the Trust Act said, given, granted to people that like prove themselves worthy and smart enough to manage a stablecoin. I might know a few, cough, cough. But, like the Fed, like going back to stablecoins, like the Fed master account, if like Circle had a Fed master account or like direct line to,
or just even if they had the same setup as Custodia, right? Where Custodia was not going to have a lending book. Everything was going to be one-to-one backed. Like if Circle had been able to bank through Custodia, we wouldn't have this issue, right?
Exactly.
Like, I get why they've spread around the reserves, right? They don't want to have like
they had $3 billion in one place.
I know.
That's insane. They had $3 billion. Like, I wonder if did they try to just like wire $3 billion at once to get out of there?
Probably
like,
could have. Probably should have tried.
I mean, I think they said that like they initiated their wire on Thursday. I assume when they saw $3 billion, like, oh, we can't do that. What if they should have just done like a bunch of small deposits? I'm just speculating here, like a bunch of like, I don't know. Who knows?
Yeah, but it doesn't really solve the issue because like, they only have 7 banks or 6 banks, or they had 8 banks and then Silvergate dropped out. They got all their withdrawals. They got all their deposits back from Silvergate, and then moved it into Silicon Valley Bank. But then that one goes down, right? And now there's fears about SBNY, right? About
SBNY?
Or sorry, the Bank of New York Mellon, right? Where they keep most of their assets.
About the Bank of New York since when?
Well, is it that one or is it? Sorry, don't quote me on this one. I'm not trying to.
We don't want to spread FUD here. We got to be careful.
I'm just trying to think of the. I'm trying to think. Oh, is the Signature Bank? There's questions about Signature Bank, right? Because like Signature Bank is also sitting on like $2.3 billion in losses, I think, which is more than what Silicon Valley Bank has. So that's why I was saying like there's blood in the water now, and now once the sharks come, and everybody's just going to be like, look, remember, let's talk about like the game theory around bank runs, right? These are like very socially prone ideas where you have a choice. You can move your money to another bank for free, right? And at no cost, and keep all your money, right? Or you can keep your money in the bank and there's a potential to take a haircut. In this case, maybe like 10 or 20%, right? Or you can, like do nothing, right? So move your money or do nothing, right? And so like do nothing really, it's always a worst case because like, why would you want to take those odds of like losing a haircut when you could just like move to a safer bank and be totally fine? So the bank runs are almost self-fulfilling because everybody wants that like free lunch of like having a deposit account where, there's not going to be any risk, but at the same time, they all want to move their money at the same time, and so it just leads to like a 2-day collapse of one of the biggest institutions in America.
Yeah, like what SVB needs to do on Monday is say like all our deposits are fully backed and fully redeemable.
Well,
and
so I think the system. Yeah, I think the best thing that could happen, right? Bullish news that could come out is one, Silicon Valley Bank finds a buyer which it wasn't able to do on Thursday or Friday. So looking into the news, actually, what happened was a little bit deeper. So let me just go through the timeline of what I found. So do you want to start with Silvergate, or do you want to start with Silicon Valley?
Let's start with Silvergate.
Okay, so Silvergate had taken in quite a lot of deposits. I think about like $12 billion in deposits at the peak last year. And like Silicon Valley, I mean, it's a tale of two banks, right? But they both did the same thing. They went out, Silvergate bought a ton of 10-year tax-free muni bonds, which on the face of it, if you're like a normal bank, is like a pretty like average thing to do. Unfortunately, they were buying bonds when the interest rates were about a 1.4% during last year. They probably bought it like 1.5%. And now those bonds are trading in the 4s and 5s, maybe even higher in 6s, depending on what risk level they had. But the thing about bonds, right, is that it's not like a bond is not like a stock, right? Mm-hmm. So a stock is like you kind of have to conjure a price out of the air. The price is just what the market sets it at. On the other hand, bonds have a very defined pricing mechanism where it's almost a science. You essentially take how much is left in the bond versus what the actual yield is right now, and then you can use some just basic math to come up with what the bond price should be, down to like the cent. And so if you're buying at very low rates and then rates increase, the bond price is going to fall and it's going to lose a lot of its value. So Silvergate bought a bunch of these bonds, and then they experienced Luna 3AC FTX blow up. They lost 90% of their depository base. And at that point, I think 2 weeks ago, they started having issues. They shuttered their SIN. They also had a home loan. So the FHLB had provided them with $4.3 billion as a loan. And they actually called that back in January. So they called that loan back early. Silvergate paid it back within 2 months. But at that point, their losses kind of were starting to creep to the point where it just didn't make sense for them to operate anymore. And at that point, they decided to wind down operations. Thankfully, everyone got their money back in full to what they put into Silvergate. I think that's the best news out of this story is that
they were able to wind down properly.
Yeah. While in this case, where you have a bank that is you could say that the Silvergate operations were run much better than Silicon Valley, even though they made the same mistakes in allocating their collateral reserves. Silvergate did a better job. So with Silicon Valley, it worked out a little bit differently, right? So same thing. They had lost a bunch of deposits, or sorry, they had their share price had like lost a ton coming into the beginning of this year. I think about 60% as the sector was cooling, venture rounds were down, and just their revenue was declining. And then last week, right? So around like last week, maybe on Thursday, Friday, the week before, Moody's announced that they were planning a credit downgrade for Silicon Valley Bank. Now, over the weekend and into the beginning of part of the week, Silicon Valley reached out to several investors to sell $20 billion of its liquid short-term bond portfolio. And they were going to do this at a $1.8 billion loss. And then they also were going to sell $2.25 billion in new shares to bolster its balance sheet, to fight the downgrade, really to like keep this downgrade from happening. Unfortunately, this really spooked the market, right? So the share issuance, which would dilute existing investors, I think they were going to add like another like 30% of shares on. So people are going to be heavily diluted. They sold a huge portion of their liquid bond portfolio. It just spooked investors. Yeah. And so coming into midweek on like Wednesday, you saw in the news that Peter Thiel and other high-profile VC funds were publicly advising their companies to pull all of their funds out from Silicon Valley Bank and just move to another thing. And so this is what really like sparked the run. And then over the next few days, the share price plunged another 60%.
So what sparked the run was Peter. You're saying that because of the rank, like the rating of SVB went down, and then they were going to issue more shares to dilute existing investors. It was all these bad signs, and so Peter Thiel and friends were like to their portfolio companies, "Yo, you should jump ship, just get out." And just like that's when you're talking about the game theory and the whole thinking around a bank run.
Yeah, exactly. Like get your money out first, move it to another bank. You'll be safe, and then everybody who's left will have to deal with the haircut coming. And so they did. I mean, you saw billions of dollars run out of Silicon Valley Bank. I think they processed like 60 or 80 billion dollars worth of withdrawals just in the past week. And by Friday, the damage was done. It was just over. The bank's shares were halted for public trading. The bank was shut down and it was put into receivership by the FDIC, and
And
that was it.
also, it's important to say, like, it was shut down first by the California regulators. It was under
Yes.
charter from the state of California, and they were like monitoring the situation first, and the ones that like moved in. I wonder if it was under a federal charter, if the FDIC was monitoring it closer, if things would have been different and things would have been more orderly per se.
I think the problem here is just, the bank was already having issues, right? Like at the end of the day, this was the bank's fault because they bought all that debt and they were incurring these huge losses,
And they didn't hedge it.
and they didn't hedge it. So it's their fault at the end of the day. I don't think there's anything regulators could have done. It's really just the bank's risk management team that exposed themselves to this and didn't hedge it properly. But hedging is expensive. It pulls down earnings when earnings were already suffering. And so maybe it just didn't make sense. Maybe they thought that, rates weren't going to go as high as they did.
In hindsight,
Yes. Yeah,
someone call Captain Hindsight over here.
exactly. Yeah. So it's just unfortunate. I saw on Twitter, and you probably saw this as well too, that there's like thousands of portfolio companies banking.
Oh, it's awful.
Yeah. Yeah.
Yeah, imagine just like raising around and then all of a sudden just getting rugged. Like, or not getting rugged yet, but like having uncertainty like this.
Or just you have
You have
$10
payroll to
million,
make.
you have $10 million stuck in Silicon Valley Bank and you got payroll, right? Now you can't pay anybody.
Yeah.
Right? You got to go out. You have to go I saw Brex was providing like credit lines for companies, or you got to go back to your VCs and like ask them to give you a loan. Like it's pretty bad.
Yeah.
I really think this is going to have knock-on effects for California, which is it's like its own economy, right? It's like the size of Portugal.
It's the fifth largest economy in the world, I believe.
Yeah, exactly. And now you have like the biggest sector in California, just like the huge problems, right? There's billions of dollars that no longer will be going to taxes or being spent. People are going to be out of jobs soon. It's really bad.
Yeah.
Yeah.
Now let's move on to how this affects USDC and like what happened in USDC, and then in turn like how it affects Frax, because we're not blind or ignorant to the facts of it was so interesting to hear last week Sam talk about like the risk-free asset, like what's the closest thing to a risk-free asset in crypto, and last week that risk-free asset was USDC. You talk to anybody, it was USDC, and that was because USDC existed in the regulated U.S. financial system as much as possible, while Tether exists outside the U.S. regulatory framework and is more of a black box. But right now, Tether is the risk-free asset. That is some irony in this plot that we are all in right now. That people are fleeing to Tether for safety, and yeah. I wonder how Bitfinex feels.
Well, it comes down to the transparency and opaqueness of these two assets.
Yeah, like Circle shares their balance sheet every month.
Every month, you know exactly where they're invested. They've said multiple times which banks they were with, and this is actually what caused the whole run. Is that Jeremy and Circle had said several times, these are the banks that we're working with. It's like 6 or 7 banks, and this is the exact makeup of our reserves, where $11 billion is with these banks, and then we have like $33 billion invested into treasuries. And so people jumped on that immediately, all over Twitter, trying to figure out how much was the loss going to be, how much was Circle exposed. And at that point, USDC started to sell off. At first it was just like half a cent, but like as time went on, well, the first big shock was Coinbase and Circle came out and said that they weren't going to handle redemptions, or they were pausing redemptions.
But no, the first big shot was the tweet just like kind of re-saying what was already known, and everyone's like, "Yeah, we knew that. How much was in SVB?" And then they came out to say that $3 billion was in SVB.
Well, they called it. Didn't that guy call Circle and he was like, "Yeah, we don't have anything to tell you at the moment, but we'll get back to you." And that was the first indication where like, oh man, like if it was like a nothing burger, right? If they had like minimal exposure to Silicon Valley Bank, they would have come out immediately and said like, we have minimal exposure. But this was like they waited.
Yeah, they didn't say anything. They didn't
say anything for a while, which means that they were figuring out how with their PR teams, like how do we present this in the right way? And the right way was just like leaking the number eventually. And so I think tier 10K came out, had a big tweet about like 3.3 billion. And then it was just off to races to figure out like, what's the exposure here? What should the peg be at? Coinbase and Circle turned off redemptions, which understandably is, has to happen because the banks are like, honestly, if this had happened on Thursday versus on Friday, we wouldn't be having these issues.
Yeah.
I mean,
the banks would have been open.
Banks would have been open, right? Also, if Circle had Fed Master account access, they could have gone and gotten like short-term loans in the form of like repos or something else from the Fed, and been able to shore up all of this instead of having to like deal with this shit, right? Really unfortunate. And so I think the redemptions being off is like the big thing. Everyone just fled for the hills. Overnight, USDC traded all the way down to 86 cents, which is just unbelievable. Unbelievable.
There's like nowhere to exit from, too.
Yeah, until Monday. Yeah.
Monday.
Yeah, Monday.
But
it like I saw some back of the napkin math, right? Where everybody's doing all these assumptions, like the kind of like broad overall general assumption about Silicon Valley Bank is that depositors are going to get probably somewhere between like 75 and maybe 80% of their funds back based on the assets that they have. Now, if Circle didn't see any outflows out of their $43 billion portfolio, this would be really minimal. This would be about like $1.2 billion in losses on a $43 billion asset. That's like 2%. They make so much money with their short-term treasuries right now. They're making like 4% on short-term treasuries at the moment, which is about $1.2 billion a year. So like within the year, they would make that up and they would be profitable again. The fear now is that there's going to be this massive run to safety from USDC, and that the supply of USDC is going to draw down from like 43 billion to like, I don't know, 10 or 20 billion. And at that point, that's when the 3.3 billion really becomes an issue, because it's an illiquid asset. It's not liquid. And so it has to be just taken out of the equation if you're planning to cash out. And so like at a $20 billion reserve amount, that 3.3 billion now becomes like 15% of the supply is now liquid, and that should probably be priced in. So you like USDC in theory would trade at like 85 cents, right? If it goes down to 10 billion, now it becomes like 33, and USDC would probably trade like somewhere in the 70 cents, right? So there's just a huge risk that there's this massive flight coming, and Circle and USDC is just going to get hammered from it. But that's like this really nasty bear case. Hopefully Silicon Valley Bank finds this a buyer. Number two, if Circle can get a credit line from someone, Coinbase or one of the other big institutional partners it has, just coming in and saying like, here's 3.3 billion, right, in credit. We're fully covering this and we'll recoup whatever we can from this illiquid asset. That would also be very helpful as well. That would be
huge.
That would be huge.
Yeah, like it's the most important thing is for SVB and Circle to come out strong out the gate on Monday.
Mm-hmm.
This isn't just about like, Circle not being able to like meet redemptions or some startups unable to bank. This is like stop an actual national bank run. like
Yeah.
like this is bigger than just USDC. And like in the case of like DeFi runs on USDC ever since the beginning. USDC was like the de facto reserve asset of DeFi. It's, I've always said Tether is the stablecoin of centralized exchanges, USDC of DeFi. And now you're gonna have this situation where like how are people gonna trust USDC again?
I think it's going to be up in the air. Like what I concluded with in the article that I was writing for today was essentially that like until there's a change in the administration, or until like the stablecoin bill that you gave your policy presentation on, until something like that passes, I think we're just going to be in this like weird gray area
Mm-hmm.
where companies like Circle just do not have
The proper
the
rails or
yes,
protections,
100%.
they're just at the mercy of these intermediaries. And this is exactly why Sam says we need a Fed master account.
Yeah,
Anything else, nothing, everything else is not, doesn't cut it. It's not the risk free asset. And like we're seeing it like play out in real time. We're seeing, it's really amazing seeing his thesis play out in real time, but in just like the most awful way possible, in the most unfortunate way possible. Like
yeah.
he's been
Honestly,
proven
yeah.
right, but at what cost?
I think that this is honestly it's been really hard for Frax over the past 48 hours. This is like the only depegging that's ever happened in the
It's a
history of the
fact.
platform.
Yeah, and like it's not like anything wrong with the protocol or any
Yes.
it was literally because of the underlying collateral. Like I guess like you can say the economic assumption of USDC being the risk-free asset, which before Friday was the proper assumption. And like once that assumption failed, then it's like really not just the Frax issue; it's all of DeFi.
Yeah.
You know,
I had proposed back in when was it? 2021 to make USDT uh, part of the treasury, and it got voted down back then. But I wonder if we had that vote again, like today, whether that would pass to like split the treasury into like half USDC, half USDT.
I mean, I guess it's better to diversify, but it really doesn't solve the issue of you're still relying on centralized intermediaries, and USDT is still a black box.
Yes. Yeah. Well, that's part of I know, and I understand. Look, I realized in the aftermath of what of that vote not passing, of like why it wasn't passed, because just Tether does not have the best reputation, right? It really doesn't. And there's been times where they've been like under collateralized by like billions of dollars, and that's not something that you really want to be collateralizing
Look at what happened.
the
Luna
base
went down
asset.
to like 95 cents.
Yeah, exactly. Yeah. So is that, do you really want that risk? And so, maybe there is more risk in Tether still, just because it's opaque and you don't know what's there. Um, but
Yeah.
we'll see. I
Do you
think
think
yeah.
Do you think DeFi is gonna make a turn towards more decentralized money? And by that, I don't mean LUSD and RAI. I mean towards ETH and ETH pegged stablecoins.
No, it's just harder, and the amount of dollars that you can create is constrained much more.
Yeah, no. I mean for like ETH, just like well, right now, yeah. Still, like
Uh,
ETH is the thing is like ETH is the most decentralized money, and you wouldn't have this issue. But but in return, you have like massive volatility, so it's hard to use it as a stable coin because it's not stable. But like, these are like the trade offs of being a small, still in an industry in its infancy.
yeah. I don't know. I can't. I think there's just such demand for dollars that are like USDC that uh, it's not going to go away. It's just going to be maybe another new. This would be a perfect time for a new competitor to come into the arena that was provide like if Frax could get their master account like today, I think it would
Should got
be
it. They should be getting it yesterday, but
yeah.
there's no political will.
Uh, if Frax could solve the Fed master account problem and switch to Frax USD from USDC, I think it would be a huge PR win and probably would lead the next wave of stablecoins.
Yeah,
Yeah.
I mean, it's either that or there's no other option really than a Fed master account, and
Yeah,
and
yeah.
I remember I forget what I was just watching. That what was I just watching? It was just going over the regulatory environment and all the was it? It was the recent chopping block interview that just got released today with Arthur Hayes, where it goes over all the different regulatory actions, from the federal government or from the Federal Reserve. I think it was that. It might have been something else, but they just had something on with Arthur Hayes. And it's just it was a good episode.
Yeah, well, I'll have to go take a listen to it. I think at the end of the day, Sam's going to come out.
Oh wow!
Very
You just sent me this. Add USDT as a collateral asset.
Yeah, that was FIP, Frax Improvement Protocol number 4. I just looked.
It got no votes.
Well, I think it's the old controller or something like that. It's just not recorded in the snapshot, but it didn't pass. And we didn't have the governance. It's not in the governance forums or anything. You got to go all the way back to the end of the snapshot. I think the more that I look back upon it, I think Sam has been very consistent in what he's been saying for the last year, and I hope that he uses this this would be really good PR for Frax. Really, is if he went out and kind of became the standard bearer against Circle in this case of leading the charge politically, or with
against
Circle, right?
With Circle.
No, not against Circle, but essentially saying look, I was talking about this a year ago about how the Fed master account access was necessary, and that we just had poor solutions. And yes, we relied on USDC, but at the end of the day, we knew it wasn't a good option, and we wanted to switch to a better one. So it's a failure of lawmakers, it's a failure of Congress, it's a failure of the regulators to grant these protocols like us, like Maker, like anybody else, right? To not bring us into the banking system and give us that access, and instead deny us and lead to this massive financial crisis that we're seeing right now with USDC.
Yeah. I mean, I think there is something opportunity to, capitalize publicly.
Yeah.
My mic. Apologies. There is an opportunity to, go out there and turn the situation around in the public forum, using the proper language and communicating the right message. And I think that is with the Fed master account, and that drum that Sam has been beating over the past 6-7 months since his first interview with us back in November of 2022. So, we'll see what happens. And at least Frax has FrxETH. That's all I got to say.
Yeah, that's true. That's true. This week's Frax check is going to be pretty incredible.
This is going to be the most memorable Frax check. I mean, did you see that 17% APR projected right there because of that massive MVB score? That's insane.
Crazy.
Yeah.
Kit's going to have his work put out for him.
Yeah.
So, Kit, you're sleeping, and we're sorry that you can't be on this emergency pod, but we're doing Frax check on Tuesday. So, or actually tomorrow.
Yeah. So, we should just wrap this up around now. This is a solid amount of time. Thank you, everyone, for joining us for this emergency broadcast of Flywheel about the USDC situation and the depegging. I'm your host, DeFi Dave. I'm here with Sam McCullough, aka Traders Insight. You can find him on Twitter. You can find me on Twitter at DeFi Dave 22. And if you want all the emergency broadcasts, all the alpha, everything you need, go subscribe down below, flywheeloutput.com. Hit that bell button on YouTube. Subscribe to us on YouTube, and make sure that you're here with us on Telegram too, at Flywheel DeFi, Twitter at Flywheel DeFi, and we will see you next time.
Stay strong, everybody.
We got this. We'll make it through. We'll make it through.
Peace.
Everything said on this episode is not financial or tax advice. This channel is strictly for educational purposes and is not an investment advice or solicitation to buy or sell any assets or to make any financial decisions. This video is not tax advice whatsoever. Please talk to your accountant and do your own research.